Why do you believe this one's like the most technology? What's keeping the MGAs from doing that?
Look, I think there is a rush to get into the market. I think there's a question of, do I have to spend money? I can go out. Here's this existing service provider that's been out in the market. They've helped a bunch of other MGAs get up and running. And there's all different kinds of models.
What does actually mean to scale operationally at those different levels?
There's so many things that go with that, right? You need to get to that 20, 50 million, absolutely, and then ultimately to the $100 million because it gives you that operational scale, right? Simple ways that you can have it's the economies of scale, right? For instance, years ago I inherited an $18 million business that's been around for about 4 years. They're running at 96 combined because they had an expense problem. Over the next 4 years, we grew that business to over $100 million, got their expense ratio down to 28, and got their combined, like 80.
Hello, everybody, and welcome to Inside Delegated Authority. Today's guest is Frank Barron. Frank has spent decades owning the outcome. He's built, fixed, and scaled P&C, E&S, MGA, and fronting businesses across carriers, programs, and platforms. He has run portfolios north of $1 billion in annual gross written premium, GWP, sat in the CEO seat, and now advises boards and private equity firms on what actually works and what quietly breaks when you're scaling. Today's conversation matters because the market is turning. Rate is softening, capital is watching closer, and efficiency gaps that were hidden before are now surfacing because the market is soft. Frank has seen the cycle before. He knows where delegated authority delivers leverage and where weak governance, bad data, and false speed start to destroy trust and value. If you care about sustainable scale, this is a conversation you don't want to miss. Thanks, Frank, for being here.
Thank you, Daniel. I very much appreciate being here. Looking forward to our conversation.
No, amazing. A lot of people always fear or ask with AI. And one of the questions that I get a lot is, where do people overestimate what AI can replace in a specialty and E&S underwriting?
Appreciate the question. As you said, AI is everywhere, right? And I think there's people are feeling a little bit overwhelmed by it because it just seems like so much is coming at them. Just so much in the news, right? It's kind of changing our lives. It's even having impacts on our, on our electricity bills. And, as I'm sure you and everyone else noticed, recently there was a survey done by the National Economics Board. And they surveyed 6,000 executives across the country, across all industries, and they're reporting about 69% are saying they're currently using AI in some way, right? So it's not just insurance, right? So it impacts all of us in pretty much every aspect of our lives. Bringing more specific, to AI in underwriting, and what I've seen over the last couple of years is people are challenged by, they feel like they've got to say, yes, I'm using AI, right? So then they try to implement it into everything, and then you just start having challenges, right? My suggestion, from my own hard-learned lessons, but also in conversations I've had even, in the recent weeks, with CEOs of, mutual companies, large insurance industry captives, and then also with private equity firms is we need to be very intentional about what are we trying to solve with AI and why, right? And unless you have the bandwidth from a people and resources point of view, from a capital point of view, I would suggest not trying to do everything at once. What I've seen work best is where you're trying to implement it in very specific areas in a smaller, less complex product area. Get the proof of concept to work, right? So you understand where is it working, where am I having issues. And what I've seen happen is if people are trying to implement significant AI implementations in operation, in accounting, finance, underwriting all at the same time, inevitably stuff is going to break. But if you have all of them going at the same time in the same stage, it's really hard to discern where's the break happening, right? Yes, we're doing them at staggered paces, but have intentionality about what you're trying to accomplish and what's the outcome you're trying to get from it.
That's a great point. Having readiness, let's call it readiness to implement AI, people, process, infrastructure, everything you need to be successful. Then being mindful that you cannot do all at once. A jack of all trades, usually not the best option in this kind of scenario. But then I would say you need, let's say, control. And when you let AI run without guardrails, a lot of things can happen. What's that first bad decision you feel could happen when there are no guardrails for AI?
I'll give you a simple example. A couple months ago, a partner of mine were working on creating a business plan for a private equity firm. And as we were using a well-known AI tool, we spent days kind of working through it, and you had all the prompts, you have all the information you got to put in. Face value, like, wow, this is pretty good. And then you start kind of diving into it, and you're like, wait a minute. It goes off on tangents, it starts having hallucinations, it starts taking some information and creating conclusions that you're like, wait a minute, like, where did that come from? Right. And I think that's just the broader applicability of, yes, it's kind of fun and sexy to work with AI, and it is a good tool, right? But it is still in its early stages. So you really do need to make sure whether you're working with data or you're working with Word documents, you really have to go through every line item. You really do have to read every word to make sure you're getting the output that you wanted and that you're applying the expertise of yourself and your team in the highest value areas, right? And to me, that's where AI, whether you're in the very early iterations of it or you're using, the large language model, learning things, or you're getting into, the agentic AI, it's still early. It's still going to have problems. It's still going to have hallucinations. And that's not inherently bad. It's just we've got to make sure we make good decisions around how we use the information.
Yeah, that's a great point, and it comes along with human oversight. What do you want to oversight? What you don't want to oversight? But then the question is, sometimes we believe we have human oversight, but we really don't. Like, what scenarios have you seen with those type of actions?
Yeah, I think we want to believe AI is gonna be a panacea. It's gonna solve everything, right? And what I've seen is sometimes it just looks too good. And you're like, and you wanna believe it, but I think it's just something where you always have to take the time to dig beneath, even if you think it looks good, because there is going to be issues in there, there's gonna be challenges, and what happens is, it's like anything, you're building a house, if you have a bad foundation, you're gonna have, settling, all kinds of problems with your home down the road. Same thing, there's gonna be issues here that if you're not spending enough time on the front end to really go through those soft launches to make sure that you're doing the quality assurance and control, you're going to find problems, right? And one of the things that you're going to see happen, and this is it happens now, and it happened even in the pre-AI days, is as good as you think it is what you've just built and you do your launch out into the marketplace, the brokers CSRs are going to find the inadvertent cracks that you left and the inadvertent trapdoors. And that's something where you guys like, if all of a sudden you're starting to sell something a lot more than you thought you were going to, that's probably not a good thing. They probably found you inadvertently priced something or you left an opening and you're providing more coverage than the market is. So you got to be going to, and I saw this play out a couple of years ago. Overall, really well run business, but they built a completely automated online platform and they didn't pay attention early enough. I mean, you've literally got to be in there every day, every week, managing. Don't let it run for a month and then come back and see what happened. They end up paying out a very significant claim because they had a trap door that they didn't realize they left open. So it's again, it's kind of this trust but verified type of thing.
Yeah, you cannot trust blindly, 100%. And foundation, I would say, is the key to being successful. And the biggest foundation that I found so far is the data that's coming in. You gotta know where the data is coming in, but where do you have seen that it gets distorted and basically started to change into something that it wasn't at the beginning?
Look, I've been fortunate, as you mentioned. I mean, I've started and built new businesses, kind of the full spectrum. Working for a very large international global organization that had tens of billions of dollars of their own premium and claims paid, all the way down to an early stage, insurtech MGA that had no data. Inherently, I don't think there's anything good or bad. It's just you got to be honest with yourself about what is the data I have available? Is it my own data? Am I getting it from a reinsurer? Am I getting it from a reinsurance broker? Am I buying it from ISO? And then, for instance, if you're buying admitted data and you're trying to use it in E&S, understand where there's potentially going to be gaps. And then you're going to load it in and you're going to start to run it through and you're going to see distortions in the information. You're going to see distortions in your pricing models. And you gotta pay attention to it because it's something that you've got to get comfortable with first yourself with your own underwriters and your own actuarial team. Then you're going to have to present it and basically justify it to fronts and reinsurers about why they should believe in it and therefore give you the ability to go to market and run that model out into the marketplace.
Yeah, it's the model, I would say, is the foundation. That's why we have also full followers that they if they see someone that's actually put in the time to work, I'll just follow this reinsurer, this MGA, because they know what they're doing and they usually have that discipline. But usually it takes a lot of time because data comes unstructured, PDFs,
Yes. Oh
Excel,
yeah.
spreadsheets. It's messy all over the place. What have you seen breaks when you have this type of data or messy data, let's call it, into models and workflows that MJs have to do every single day?
Yeah, no, I'll share a couple of quick examples with you. In one of my prior lives, we had a very significant program group where we were giving delegated authority, and we would literally see hundreds of submissions a year come in from MGAs for every product line kind of imaginable. And most of them, honestly, were kind of the electronic version of crayons. Yeah, it's just like the data was just bad. Just the way it was presented, you just tell it just wasn't structured properly. They didn't put in kind of enough ownership to it. So some of you just see on the front end, it just doesn't create confidence of this has really been thoughtfully put together, nor will they properly manage it as they go forward. Then you go into kind of the smaller subset of folks that really do have what appears to be good data. And then as you start to run it, you're going to see issues, particularly, if you started off as a monoline MGA, you're going to start to see stress even within the monoline as you go to additional iterations of the existing product, let alone as you try to then go into other products, particularly if they're less related or unrelated to the first product that you did. Right? It's just that's where the complexity comes from the breadth and scale that as you try to grow your business, how do you actually continue to have a really good handle on that information, regardless if you're in a soft market or a hard market.
Yeah, that's from messy data to trusting the data. I tend to call it quality control. So you make sure that
It
everything
is, yeah. Yeah.
is in
Yeah, I
place.
mean, Yeah, I mean, prior lives, I would have chief underwriting officer for my property, chief underwriting officer for my casualty, and every month we would, when we were a very mature, up and running business, we would have monthly meetings about how are we actually running the business? Are we actually doing what we say we would do? Right. So part of it is from an actuarial point of view, but also from an underwriter point of view. Look, I'm a lifelong underwriter, right? So we like to be creative. We want to be problem solving. There's a band that you can operate in. And, sometimes you have folks that want to get a little too creative and they start going outside the band. And you got to be paying attention to that as well. So it's not just the model, it's actually how is it lived by the underwriting side and the operation side.
Yeah, those are, I would say, two sides that we need to keep in balance: underwriting quality, operational efficiency.
Yes.
They tend to coexist really, really well. But right now, we're in a soft market. Which one do you believe gets exposed first when, let's say, things didn't go what we expected?
Okay. Yeah, as you know, right, and certainly this is very relevant for the reinsurers. Globally, the P&C, the commercial P&C market has been in a softening market for 6 quarters. Now, in the U.S., it's a little bit shorter. Obviously, it started more, generally speaking, in the property market, a little bit into the casualty market for the U.S. But where that's going to show up first is really going to be on the operation side, right? Is that if you're a carrier MGA and you've had a mid to upper 30s expense ratio, combine that with dropping premium, and then you're still trying to look at, do the appropriate trend on your line business, you're going to get into world of hurt pretty quickly in 26, 27. And to kind of paraphrase, the Warren Buffett quote, when the tide goes out, it's going to expose who's been swimming naked, right? And there's going to be a bunch of folks that have been going to show in 26 and 27. They've not been wearing shorts. It's something I've again I've reminded my underwriters for many years is we have to have discipline in all aspects of our business. So that's the operating expense ratio and on the underwriting and loss ratio side, right? The most durable one is the expense ratio. Kinsale has done a phenomenal job of that. When you have a phenomenally low expense ratio, the market loves that. Because yes, you will always have some volatility in your loss ratio, but if you have managed a very good business and have a 30 or below 20s expense ratio, that covers a lot of sins on the underwriting side. Yeah, that would give you more flexibility to ride a soft market.
Yeah, I would say insurance is the only business that you get paid first and then you have to deliver the service.
Oh, absolutely, right? I mean, we've seen it before, right? Less so on property, but absolutely on casualty. As you know, many of these casualty lines, like you don't really start to get a sense of your loss ratio until 3 years after you close the books. And as has been talked about, and I think you're going to see in 26 and 27 and going forward, is a number of folks are going to have to take reserve increases on their prior years, and then that's going to put pressure on what is the loss ratio of their booking their existing business in 26, 27.
Yeah, and that's now it comes to mind like a great question because we come from a hard market, and what do you have seen out there that we're actually riding the rate basically because it was good market for everybody, and who was actually building a real advantage? How have you seen that balance between riding the rate and actually building something that's a real advantage?
Yeah, it's a great question. It's again something that I've preached to my own groups when I was underwriting. Now I very much engaged in kind of the consulting work that I do is hard market will cover a lot of sins. And because this was an unusually hard market for duration wise, and people I think got lazy. And this is something that you gotta be always paying attention to. Back to my earlier comment of a really great business, and this is what you're gonna see, kind of play out in 26, 27 going forward is have you actually really been paying attention to am I always growing my policy count? Am I always paying attention to my retention ratio? And very importantly, am I truly building great distribution relationships so that they really like me? That even as the soft market comes and they're getting more competitors coming in, uh, that they still want to do business with me, or was I kind of like, yeah, kind of a friend of me, but now that I got other options, I'm going to go someplace else, and that's going to get pretty exposed pretty quickly in the coming next 18, 24 months.
Then that if that's going to be exposed really quickly, what do you feel in 26 and 27 is going to be breaking that people need to be mindful or and prepared to?
I think there's going to be a few things that all of a sudden it's going to expose what I would characterize as the three categories of MGAs, brokers, and underwriters as we go forward. You're going to have the clear winners. You're going to have those folks that created worthwhile businesses, but maybe having expense issues. Them would be them potentially a good M&A candidate, and then you're just gonna have the Walking Dead, and they're gonna figure that out over the next number. Because then what's gonna happen is their expense ratios are too high. They didn't grow fast enough in a prudent way to get to scale. Then they're going to start to be losing money. Then they're going to lose the value proposition for their employees and distribution and the capital. That's what, yeah, in an overall way, I guess that's what's going to break, right? The market is just going to start having more clear fissures in the coming months and years.
Yeah, when I've seen fissures, I start to see a lot of consolidation M&As, and you have done this in the past, but
Yeah, I mean,
what
you're already starting to see it, right? I mean, Zurich going after Beasley, right? Others is you start getting into the appropriate thought process. How likely am I to grow in the areas I want to grow, and what is the cost versus buying another business? Like buying Beasley as the entirety, or are you like in an MGA market where it's so expensive to buy another MGA? Is it more prudent to be able to go out and get teams of people that you want, and then give them equity, and then have your upside, right? And that's sort of the conversation I'm having right now with private equity firms: is should they buy MGAs the entirety, or should they be looking at more at doing lists of teams and people?
now that you're advising that, what type of clarity do you look within segment, value prop, distribution to say like this is a business that's worth investing, that has a lot of upside, that I can 2, 3x, 5x, 10x in the next couple of years?
Look, I think this is something that still kind of surprises me to this day, that people don't have a clear understanding of what is it you're trying to accomplish, who you're trying to be, and why, and what is the value proposition that you're providing to your investors, to your distribution partners, to talent. If you can't answer those simple questions, which quite often they can't, you gotta go back to the drawing board, right? Because it's like, I want to be in the MGA space. Well, okay, that's great. There's 700 distinct MGAs in the country today. Okay, so what? Now what do you want to do with it? Or I want to be an MGA into a space that nobody else has gone into before. Like, okay, do you really understand that the industry that you're going after? I think P right now is a little bit uneasy, particularly if you're late into the game of you're starting to see rates come down. How should I value? Right. And that's where I think you need to have clarity of being able to engage with any organization, be it a carrier, broker, or MGA, what is your true economics? Where are you making money? And what is your risk appetite for deploying capital? If you're looking to really deploy, relatively speaking, lesser capital, you go to the broker side. If you kind of have, some, right? Because as you know, right now, for years, many reinsurers are requiring the fronts and the MGAs take risk in some form. So you got to put some additional capital in. And then, if you're really adventurous, you go all in and you buy a carrier and you build a full stack operation. But it's just intentionality. Like, what are you trying to accomplish? What does good look like? And then what is your horizon? And then what's the type of return that you're gonna get out of it? That you're trying to make solid estimations and feel confident that you can deliver it on for different stakeholders in this environment that we're going into.
Yeah, and that's a great point. Thanks for sharing. But as an MGA, you have a leaner organization that with this massive type of companies. What do you believe they should focus first on what talent? It could be, let's say, underwriting, operations, claims, distribution. Which one do you feel it's the most relevant and why?
Yeah, I mean, honestly, yeah, that's a key question. When I engage with folks around this question, to me, it's very much who are the founding partners and what is their skill set? Right? So quite often people are focusing on, I want to go out and hire strategy people or operations people or underwriting people. That's great, right? But then I would say what generally takes the longest to build is really that operations and technology platform. So again, as a lifelong underwriter, I think you need to have clarity of what space you're trying to go into, but you need to be focused very early on into your operations technology folks, because if you don't invest in them properly and don't have them aligned properly with the underwriting very early on as you build everything out, you're going to be paying for your sins the entirety of your business, and it can get painful.
Why do you believe this one's like the most technology? What's keeping the MGAs from doing that?
But look, I think there is a rush to get into the market. I think there's a question of, do I have to spend money? I can go out, here's this existing service provider that's been out in the market. They've helped a bunch of other MGAs get up and running. And there's all different kinds of models. I recently had a conversation with a good friend of mine. He started up his MGA like 5 years ago, and it was, related to one of the well-known kind of incubators. And even within, a well-designed incubator environment ecosystem, he shared his own experience of he put in more time and effort, spent months working with their tech platform provider to really create systems and processes that were more specific to the type of property he wanted to do. And now 4 or 5 years later, as he's having conversations with his counterparts that built out other businesses in property and in GL and professional liability, they're expressing pain because they rushed to get it out to market quickly. They didn't spend the time to have the conversations with the service providers. Here's what I'm trying to accomplish. And again, hard market will let you get away with much more so of having a tough process for CSRs to deal with. In a softening market, particularly if you're in E&S and you got more of the really good admitted markets coming in with good technology, you're going to face real challenges.
Yeah, on those challenges, you have scaled businesses from 0, 20, 50, 100 million, 1 billion plus. What does actually mean to scale operationally at those different levels?
There's so many things that go with that, right? You need to get to that 20, 50 million, absolutely, and then ultimately to the $100 million, because it gives you that operational scale, right? Simple ways that you can have it's the economies of scale, right? For instance, years ago I inherited an $18 million business that had been around for about 4 years. They're running at 96 combined because they had an expense problem. Over the next 4 years, we grew that business to over $100 million, got their expense ratio down to 28, and got their combined, like 80. So it's it gives you the operational efficiency, but then it also gives you the ability that inevitably, in most lines of business, you're going to have some severity losses. And it's a heck of a lot easier to have a conversation with reinsurers that you had a 2 million, 5 million, $8 million loss on $100 million book than I did on an $18 million book. So for them, the small books, that becomes a shock loss. For the bigger book, it's kind of part of what you expect to have happen over the duration of your 3, 5, 10 year kind of loss triangles. And it's just something that you need to understand that, again, as you're building out your business, and to me, this kind of goes back to one of my earlier points about if you anticipate to build a multi-line business, then you need to be anticipating the breadth and depth and complexity that comes with that as you add not only more products, but even more iteration of existing products. That scale gives you the ability to be able to afford to do the operations and do it in a very efficient and effective way. So therefore, it provides a very good experience for your distribution partners and also provides a very good experience for your internal users. One of the things that you constantly hear from underwriters is, "Hey, it's great. I'm now making whatever 25% more money, but God, the system sucks. My daily life is miserable." The paycheck, but quickly kind of get used to and it kind of fades away. But if every day you're living a painful existence, you may become more receptive to taking that phone call down that road. Somebody's got a better day-to-day life for you with a better system.
Yeah, that's when you were mentioning before that, let's say launch fast with basic systems and then we'll see how it goes. What are the biggest mistakes that you have seen when people do that and then later on they have to pay for them?
Yeah, it's again, it's kind of rush of like, oh, I know I want to go into this space. So they build a monoline platform for one line of business. Right? So for instance, if you're going into small commercial property. And then a year, 18 months, 2 years later, say, hey, I want to go into GL. Oh, wow. Apples and oranges, right? Like the piping has not been set up for that. And it just becomes very difficult. It's kind of like you bought the little cottage by the ocean and now all of a sudden you want to make it into a house that's, 4 times the size. It's, 2 stories. You can't tear it down and you're trying to build scale at the same time. Again, just spending more time on the front end, being very intentional, right? You don't have to build everything yourself. You can get some really good technology and capabilities, but that's where you need very capable ops and technology people to understand what must we own versus what can we buy or rent from somebody else and how to effectively integrate them for where we want to be 2 years, 3 years, 5 years from now.
Yeah, that's a question that people are always juggling, build versus
Yeah.
buy.
Yeah.
If you have to do it all over again, how would you do it right now with all the knowledge that you have accumulated through the years?
Again, I can tell you, this is plan that we're recently working on. It was have specific vendors I worked with in the past and or I'm very familiar with that I would work with for instance this one lady of mine, it was an excellent expert kind of in the operations side, and it would be the intentionality of this is kind of the core system that we're going to buy. And then these are the different vendors that for the systems that we need that we have to add on, for accounting, finance, compliance, all those different things. And then also for the lines of business that we're going to be in, this is the vendors that work best for, right? So you need to be intentional. Am I going after national accounts, financial lines, or am I going after $2,500 small BOP or small, property policies? They're not one and the same, and there's not a one size fits all from all vendors, right? So you need to have intentionality again about who am I trying to be, where am I going?
No, really appreciate the time, Frank. Really enjoyed our conversation. Thank you very much for sharing all your knowledge and really appreciate having you here. This was Inside Delegated Authority. Thank you very much.
Appreciate it. Have a great day. Be well.
Bye bye.
Bye.